Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on Indian road sector entering the slow lane. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Anand Rathi, Chief Financial Officer at GR Infraprojects Limited. Mr. Ankit Jain, Chief Financial Officer at Cube Highways and Transportation Assets Advisors Limited. Mr. Ankit Patel, Head of Research, Credit and Fixed Income, HSBC Asset Management India Private Limited. Mr. Gaurav Chaturvedi, Head of Corporate Finance and Strategy, NXT-Infra Trust. This session will be moderated by Maulesh Desai, Director at CareEdge Ratings. We will commence this session with a presentation by Setu Gajjar, Assistant Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Setu to make the presentation.
Thank you, Mamta. Good afternoon and a warm welcome to everyone to CareEdge Ratings webinar on Indian road sector, entering the slow lane. We shall now commence the presentation with key messages. Sustenance of healthy traffic growth is expected to lead to toll growth of around 7% in FY25. Introduction of revised model concession agreement under the BOT toll model is a welcome move. However, the extent of bidding aggression and on-ground enforcement of the clauses shall remain key monitorable. 152 road assets with an AUM of 2 lakh crores are transferred to InvIT as on September 30, 2024, with most of the mature BOT toll assets being in the InvIT. HAM monetization potential stands healthy at around 2 lakh crores for FY25 to FY27, albeit with limited upside. Execution of HAM projects with BPC of around 1 lakh crores are delayed beyond 6 months. Scale of operations of the road developers are expected to decline by around 5% in FY25, with moderation in margins from 14% in FY23 to around 12% in FY25. NH pace of construction is expected to decline by 10% in FY25. Today's presentation is broadly divided into 3 parts. Outlook on toll roads and CareEdge Ratings view on revised model concession agreement for toll roads, study of 375 NHAI HAM projects and its impact analysis on major road developers, and asset monetization momentum and its potential. Let's glance at the investment trends in the road sector before we move to the first section of the presentation. Over the last decade, the sector has seen a cumulative investment of over 28.5 lakh crores by both the central and the state governments, registering a compounded annual growth rate, that is CAGR, of 15%. State capital expenditure on roads has also gained momentum over the years. Uttar Pradesh, Maharashtra, Tamil Nadu, and Odisha are the key states with huge capital outlay for roads over the last 5 years ended FY24. Despite expected slowdown in the pace of construction by national highways, capital outlay for the sector is expected to grow at a CAGR of 14% over FY25 to FY26, primarily driven by the increasing cost of land acquisition and a focus on greenfield expressways. Let us begin our first section on the toll roads. Aggressive bidding in the roads sector post-March 2020, coupled with a perceived notion about inadequacy of construction quality under EPC mode, emerged as a prominent sector challenges by the road sector. To address these issues, the Ministry of Road Transport and Highways has revamped the BOT toll concessions to safeguard stakeholders' interest. Let's look at the key features of the BOT toll roads under revised MCA. Under the revised MCA, there is a requirement of minimum of 90% of the construction zone to be available as on appointed date. This is expected to effectively reduce the extent of delinking for the issuance of PCOD and pave way for smooth project implementation. The authority's right to terminate slow-moving projects in the interim phase is expected to enhance the developer's focus on the project execution and enable sponsor substitution for languishing projects. Availability of fixed construction grant equivalent to estimated toll collection also mitigates traffic risk in the construction period. It is pertinent to note that the construction grant and equity support from the authority cannot exceed 40% of the total project cost. Additionally, the revised model concession agreement provides clarity on the target traffic calculation with introduction of concept of equivalent vehicle units, that is EVUs, in lieu of the prevailing calculation based on passenger car units, that is PCUs. Moving forward, according to CareEdge Ratings, revised MCA for toll roads addresses the execution challenges and ensures funding risk to an extent. In contrast to the nil termination payment before COD under the old concession, the revised model concession protects lenders' interest up to a maximum limit of 54% of the debt due. The approach of offering a predetermined grant in place of toll collection rights during the construction phase is a welcome move to reduce the risk of cash flow fluctuations. CareEdge Ratings estimates total funding support in the range of 20 to 32% of the total project cost from the authority during the construction period. However, this support is estimated to be below the threshold of 40% of the total project cost as stipulated in the concession agreement. CareEdge Ratings estimates leverage to be at around 52 to 64% of the project cost under the revised MCA compared to 64 to 70% under the old toll concession, which is a favorable from credit perspective. Going forward, the on-ground implementation of extension clauses in case of underachievement in EVUs will be crucial, as these clauses are not linked to the toll revenue. In CareEdge Ratings' opinion, introduction of the revised MC under the BOT toll is a welcome move. However, the extent of bidding aggression and on-ground enforcement of the contractual clauses shall remain key monitorable. Commenting on the changes in the toll operate and transfer, that is TOT concessions, reduced thresholds from 20% to 5% to gauge variations in the traffic performance and increased frequency of testing target revenue are favorable amendments. Next, we will discuss the study of around 100 operational toll roads. In line with CareEdge Ratings expectations, toll collection during FY24 witnessed a healthy growth of 11%. Toll collection post FY21 has registered a healthy double-digit growth driven by higher WPI and the receding impact of COVID-19. Increased economic activity, ramp up in domestic coal production and mining volumes, and improved connectivity of the feeder roads are the key accelerators for the toll growth. However, existing toll roads face risks such as traffic cannibalization from the upcoming greenfield expressways, expected modal shift from roads to rail, and regulatory risk associated with the state toll projects. With lower WPI during the current year and stable traffic, CareEdge Rating expects the toll collection to grow around 7% year-on-year during FY25. The sector outlook for the toll roads is stable. Now, we shall present an assessment on the NH-HAM projects. CareEdge Ratings has studied 374 NHAI HAM projects with an aggregate length of 16,000 kilometers and a total bid project cost of over 4 lakh crores. These projects were awarded from FY16 to FY24. As shown in the top right chart, around 42% of the sample BPC aggregating to over 1.65 lakh crores have become operational. Approximately 45% are under construction and the balance 13% are awaiting appointed date. Moving to the under construction portfolio of 1.83 lakh crores. Projects with a BPC of over 40,000 crores as of September 30, 2024 have been awaiting appointed date for more than a year since being awarded, increasing the risk of project termination. Increased focus on greenfield expressways and highways and consequent challenges towards the land acquisition is a prominent reason for the prolonged delay in the receipt of appointed date. The pie chart on the right-hand side provides an overview of the under construction projects. 55% of the projects of the sample projects with an aggregate bid project cost of over 1 lakh crores are delayed by more than 6 months. It is important to note that the delayed projects span across all sponsor categories. During our last webinar, CareEdge Ratings had highlighted execution challenges with around 1/3 of the projects being delayed, which has now increased to around 55%. Uniform construction period of 2 years irrespective of project complexities, non-availability of hindrance-free right-of-way, and excessive rainfall are the prominent reasons for delayed execution. After looking at the execution challenges, let us glance at the competitive intensity in the NH-HAM projects. As shown in the graph on the left-hand side, aggressive bidding in NH-HAM projects across sponsor categories have steadily reduced the bidding premiums compared to NHAI cost, with the median premium being negative during FY24 and Q1 of FY25. The median numbers of bidders has also consistently risen from 4 or 5 bidders during FY19-20 to around 10 bidders, with maximum of 21 bids received in FY24 for a single project. Competitive intensity continued to remain high for EPC projects as well. Moving on to award and execution trends, in line with CareEdge Ratings' earlier estimates for 24, The pace of construction for national highways saw a notable increase of 20%, reaching 34 kilometers per day. However, this pace is still below the 37 kilometers per day achieved in FY21. CareEdge Ratings expects decline in the pace of construction of national highways by around 10% to remain around 11,000 kilometers for FY25. Prolonged delay in the receipt of appointed date, execution woes, and heightened competitive intensity are the prominent reasons for the same, as seen earlier. Subdued awarding activity in FY24 and year-till-date FY25 is also one of the major sector challenge. In the context of declining pace of construction and subdued awarding, let us analyze the financials of key sponsors who also act as EPC contractors for this project. As shown in the slide, the total operating income grew at a CAGR of 14% from FY21 to FY24 due to timely project execution. However, CareEdge Rating expects a 5% decline in top line during FY25, owing to heightened execution challenges and pending receipt of appointed dates for a large number of projects. Lower projects awards have reduced revenue visibility, with order book to turnover ratio declining from 2.78 times in FY22 to 2.15 times in FY24. Furthermore, significant orders in the order book are awaiting appointed dates, resulting in much lower executable order book, moderating the revenue visibility for the road developer. Operating profitability is expected to steadily decline by 200 basis points in FY25 from FY23 levels, owing to increased competition and high overheads. Moving to the next slide, the Atmanirbhar Bharat scheme introduced during COVID-19 provided respite to contractors and eased the working capital intensity, with gross current asset days remaining stable between 180 to 200 days. With the discontinuation of the scheme, working capital intensity for the sponsors is expected to increase by around 15 to 20 days in FY25. Leverage across sponsor categories remain comfortable, backed by debt to EBITDA ratio of 1.32 times during FY24. However, moderation in profitability and increased working capital intensity are expected to marginally increase the leverage going forward. Sponsors with a pool of operational assets will be better positioned to manage the leverage and their liquidity. With this, we conclude our HAM study and its impact analysis on sponsors. Moving to the last section of asset monetization past as well as its potential. Asset monetization under the national monetization pipeline has gained significant traction, driven by strong investor appetite, leading to successful asset transfers and higher realizations. The transfer of toll assets under NHI InvIT and the traction in TOT projects have facilitated the monetization of around 40,000 crores during FY24. With a robust monetization pipeline and an established InvIT vehicle, the monetization target for FY25 appears achievable. Moving ahead, InvITs have proven to be a successful vehicle for asset monetization, providing investors with relatively stable returns. With a total asset under management of over 5.5 lakh crores under various InvITs in India, road InvITs hold the largest share with an AUM of 2 lakh crores as on September 30, 2024, spread across 152 road assets. Mature toll roads constitute a lion's share, with 57% of the asset being toll road assets, followed by HAM assets at 28%. As shown in the graph, an additional 49 assets have been transferred to InvIT since last year, including 26 HAM assets and 22 toll assets. Traction in monetization of HAM assets, benefit of asset monetization through the TOT and NHI InvIT, and change in hand for some toll roads are the prominent reasons for the same. Let us now review the stake sale of operational NH HAM projects from FY18 to year-to-date FY25. Over the past 6 years, operational HAM projects worth over 80,000 crores have been monetized, enabling various sponsors to realize approximately 13,250 crores from the stake sale of 55 HAM assets. As depicted in the graph, projects with low leverage and those bid at a healthy premium over NHI costs have achieved better realizations. Additionally, as seen in the right side of the chart, higher price index multiples for assessing project completion cost and increased bank rates have aided the valuation multiples to 1.75 to 2 times. Moving on to the monetization potential of NH HAM projects, there is a potential of 50,000 crores for existing operational HAM projects. Looking ahead, with more HAM projects becoming operational, CareEdge Rating estimates that the projects worth 1.5 lakh crores will be available for monetization, bringing the total monetization potential for the next 3 years to around rupees 2 lakh crores for FY25 to FY27. However, challenges may arise as the newly operational projects have higher leverage, ranging from 42 to 46% as compared to 36% for the previously monetized assets. Besides, these projects were awarded during the periods of intense competition, often at a discount to NHI cost. Also, peak bank rates and lower price index multiple may limit the valuation prospects. So, despite the significant monetization potential, the valuation multiples and the investor appetite due to perceived risk in the quality of construction needs to be closely monitored. With this, we end our presentation. Thank you. Over to you, Mamta.
Thank you, Setu. Attendees are requested to key in their question, which we will take up at the end of our panel discussion. Now, may I invite Maulesh Desai to take over the session, please. Maulesh Desai is the director at CareEdge Ratings for the transportation sector and handles the portfolio of infrastructure sector companies. Maulesh is a certified CWA, holds a bachelor's degree in engineering and an MBA in finance. He is also an associate member of ICWAI and a certified associate of the Indian Institution of Bankers. He has garnered over 18 years of industry experience. Over to you, Maulesh.
Thank you, Mamta, for the quick introduction, and many thanks to Setu for sharing the 360-degree perspective on the road sector through insightful presentation. Good evening and very warm welcome to all the participants. It is our pleasure to have four industry experts today to discuss threadbare on the road sector and share their deep insights before us. I would now like to introduce each one of them in the alphabetical order. First one is Mr. Anand Rathi. Mr. Rathi is the Chief Financial Officer of GR Infraprojects Limited. He has been associated with GR Infra since March 2009 in leadership role and handling gamut of responsibility, including fundraising, asset monetization, project finance, and strategic decision making. He is an associate of Institute of Chartered Accountant of India, an associate of Institute of Cost and Management Accountant of India, an associate of Institute of Company Secretaries of India. He brings over 25 years of rich experience on the table. Welcome, Mr. Rathi.
Yes,
Next
good afternoon.
panelist is Mr. Ankit Jain. Ankit is Chief Financial Officer of Cube Highways and Transportation Assets Advisories Private Limited. Ankit holds a finance degree from the University of Delhi. He has an overall experience of more than 15 years in the field of investment and infrastructure. He has closely completed the transactions with acquisition of USD 1.5 billion asset and advised structuring key infrastructure projects valued USD 8 billion. His experience spans across acquisition, bidding, project finance, fundraising, valuation, consultancy, and transaction advisory across many multinational organizations. Warm welcome, Ankit.
Thanks, Maulesh.
Our third panelist for today's session is Mr. Ankit Patel. Ankit Patel is Head of Credit Research Fixed Income with HSBC Asset Management India Private Limited. He has wide experience across sectors of oil and gas, power, infrastructure, manufacturing, etc. He possesses MBA in Finance from Narsi Munji Institute of Management Studies and BTech in Electronics and Communication from Motilal Nehru National Institute of Technology. Welcome, Ankit. And now let me introduce you to our fourth expert, Mr. Gaurav Chaturvedi. Gaurav is chartered accountant with extensive experience in the infrastructure, particularly in raising debt and equity financing. Gaurav has over 19 years of experience with a strong background in infrastructure projects and M&A transactions. He has worked with major organizations like L&T and HSBC and played a key role in establishing Enterprise Trust. Gaurav is currently associated with Actis Group, where he serves as the head of corporate finance and strategy in NXT-Infra Trust. Welcome, Gaurav, in today's session. It's time to quickly set the context before we begin the panel discussion. As seen in the presentation, Indian road sector has witnessed a transformative journey over the last decade. The same is visible from increasing operational portfolio of HAM assets and monetization thereof, low leverage of majority road developers, strong performance of operational toll roads, and bolstered investor confidence for TOT and InvITs. Yet, the sector witnessed heightened bidding aggression over past 3 years, prolonged execution delays, perceived issues in construction quality, and low project award, especially during last 2 years, which are likely to continue as a headwinds. Will all these challenges push road sector to slow lane? I would not like to impose myself further and turn towards our speaker to tell us how they think this will work out. So let me request Mr. Rathi to share his views first. So as seen in the presentation, CareEdge Ratings has observed the case of NHI HAM projects that those projects are getting PCOD upon 60 to 90% of completion of the work front, while delinking the balance work, de-scoping of unavailable work front. However, access to at least 90% of the construction zone, that is the effective work front, on appointed date, and second, the stricter clauses for termination of delayed projects are introduced under the revised MCA. So, which is a welcome move for tackling the execution. So, what is your view? Do you think this will help in minimizing the construction risk?
Yeah, thank you, Maulesh. I agree with your point. Maybe because of various changes which has been incorporated under the revised MCA, I believe that those changes have been brought in for the basically that ongoing issues, probably the industry which is facing. Once, of course, is that a delay in execution, and execution is, I believe that there are some reasons, maybe because of that some sort of engineering has been done, right, while approving the DPR by the NHI or more even. I mean, so generally you'll find that each and every projects are now, given the tenure of 2 years of period, irrespective of the length or the volume or the value of the project. And for that basic reason, I believe that even if the project is smaller or bigger, and the bigger projects actually, if they are allotted only 2 years of time for construction, delay is bound to happen, right? And of course that land acquisition piece or the condition precedent which are to be complied by the authority has not been up to the mark. So they have come up with a stricter clause that 90% of construction zone has to be made available on day one, and then continuous monitoring of the construction by way of because they have introduced some sort of like that lenders and independent engineers also be talking, right, which was not available, which was not present, and that kind of clauses was not present in the earlier MCAs. Similarly, if the project is on not on the track, is delayed, right, so then we have to give the concessionaire has to give the revised plan, and if it's not followed properly, then they have the authorities having the right to terminate, right? So this, of course, prompt the concessionaire that they would be more focusing on our execution. And of course, because more projects now they are targeting under BOT model, where more equity would be, basically that more equity would be pushed in by the concessionaire, and there would be a bigger stake of the concessionaires there. So I don't think that going forward, the concessionaire would be, taking this kind of, I mean, they will try their level best to complete the project before time or on time. That would really, I believe, that would be a welcome step. Yeah.
Yeah, so your response does also echo with our view on this aspect. And you mentioned two important aspects that the equity commitment would be higher as compared to HAM. So the skin in the game of developer is higher. So that would reduce the construction risk to an extent. And second point that you are saying is still the steps need to be taken in with respect to the aligning the construction period to the project complexity, because construction period is uniform across the uh, project. So that's one challenge. So yeah, thank you for sharing this perspective. So now I urge Mr. Jain to share his views on the same revised MCA. So as mentioned in the presentation by CareEdge Rating, the peak debt requirement under this revised MCA shall be lower by 10% as compared to old toll concession due to availability of the equity support. Also, availability of the construction support shall eliminate the traffic risk during construction period. So, basis these two things, do you think will it help in improving project IRR and improving bidding appetite?
Thanks, Maulesh.
We have a slightly different view on both these clauses. While we understand authorities' perspective, that it is done to say improve the viability of the project, but I feel one with respect to say the construction grant, which is there now. This construction grant is fixed. I totally agree that that it is done to make sure that there is a good visibility of cash and it's not dependent on say the revenue risk, but at the same time I feel that generally whenever anyone would bid for BOT projects, the person would be very clear about the traffic risk and would be bidding accordingly.
Yeah,
So
obviously.
so what I feel is that that should not be a challenge, but one repercussion that it can happen, that it can lead to, is that suppose there is a delay in construction. So one of the risks that we have seen is that in past, I mean, if the construction is say, scheduled for 3 years, now it can take 3.5 years, 4 years. The bidder will lose out on the revenues. So I think that that is just one repercussion which is there, which we have also mentioned to the authority, if something can be done in that aspect. So that is probably the risk here. On the positive side, yes, we feel that there is a certainty of revenue numbers. Now, when it comes to the leverage side, I think there is a restriction in the clause. So it says that equity support cannot be more than 50% of equity. Now, what happens is,
Yes.
if you see, I mean, generally, if I take the total quantum of 40% as grants, so the bidder will be left with 60%, which needs to be funded through debt and equity. Typically, we have seen debt equity ratio in probably, I would say, 66 to say maybe 33%, or 2 is to 1. So basis that we can take 40% as debt, 20% as equity, and 40% as equity grant. Now, what happens is, because it says that the equity support cannot be more than say 50% of the equity. So if you look at the maths, if construction grant is 20%, equity support someone wants to bid 20%, that means 40% has to be given by way of equity, and only 20% can be taken as debt, which may seriously impact the numbers. So I would say it may be a little difficult for the authority, because every bidder will price in all these costs, and equity, we all know, will be expensive compared to the debt. So may not be able to realize the full value of the project. But yes, I mean, these some of these concerns has been raised to the authority, and authority, I can tell you that they're very proactive in understanding these concerns, and are also working on how we can, or how they can improve on these aspects. Thank you.
Thank you, Ankit. So broadly, to summarize, you have raised two major points. One is that in case of delay in the construction, your tail period would be reduced. And since here the tenure of the concessions are relatively lower, so that can impact the project IRR in case of delay in the construction. And second aspect, you are saying that the with respect to the equity support, since equity support is to be the 50% of your total equity that the developer is infusing. So in that case, on paper, that support may not exceed the 30 or 32% as what we are also anticipating, although the concession agreement has a on paper clause of 40%. So understood these 2 points. So thank you very much for the same. So now we have here the developer and investor perspective. So coming to you, Mr. Ankit Patel, for the
Maulesh, I can't hear you.
I think some network error at more place maybe, I think.
Oh,
Right.
thank God.
Yeah. Yeah. Let's wait.
Yeah.
Your
Sorry,
team is there or not?
sorry.
Yeah.
Actually, some trouble in the laptop happened all of a sudden, so that led to this issue. So very sorry for the same. So yeah, I was asking to Ankit, Mr.
Yeah.
Ankit Patel, on his view on the operational toll road projects, especially if we see over from FY21, there is a notable growth in the toll collection. Plus, many assets, toll road assets, their credit profile has also improved post their transfer to InvIT or the refinancing. So, in this context, what is your experience in funding of the operational toll roads, TOTs, and InvITs?
So I think thanks for having me, and thanks for the presentation. Um, I think in terms of funding of these projects since 21, most of the toll projects that were executed before, uh, a very little number of projects actually came up in terms of the tolling in the middle period. We are talking about prior to 21 and in around that period, new projects, because of ham really picking up at that time as the model that was mostly preferred. So the projects that were completed before, actually, so there was a very good amount of traction seen wherever they had already become operational. And I think the key aspect over there is always the financing. Um, so if the cost of financing can be brought down, obviously these projects, assuming traffic estimation is what plays out, the returns are bound to go up. Um, but at the same time, the key challenges here, they would have been in terms of the other aspects which are not controllables. So again, in various cannot say this for all the projects, but in many places we've observed that naturally there are things like some of the expressways coming up, or some of the state highways coming up. And while there have been always attempts to control this kind of a competing road concern coming up, I think it's a long concession period, period of 15 years or whatever, when toll has to be collected. And during this period, things change, governments change, policies change, and this kind of a competition has resulted into some kind of traffic impact. So that is something that it's difficult to preempt. But I think from an investment perspective, the way we look at it is, the InvITs actually give us a fairly good diversified profile in terms of, so say if one of the projects gets impacted by this kind of an event, it's something that it's difficult to predict will happen. Although you try your best in terms of doing the due diligence initially itself to see if the traffic projections look okay, the cost of funding is fair, and the annuity expectations are also fair in terms of looking at the covers. But that's something that you estimate and try and see if you take an exposure instead of taking a direct exposure in, say, a single project, maybe compared to before, when you were exposed to more concerns when it came to a common in say investing in a company which was having multiple projects, compared to that in an InvIT, in case there was one of the projects or one of the SPVs which was going to face this kind of an issue, then you are spreading your risk across a more diversified asset base. So that is something that has really come through. And obviously we have investments, again, it has come to such an extent that probably it's InvITs have been the ones who have been raising the financing. That diversified approach, as well as management, as well as the controls that are put into place, has been a far more simpler and straightforward investment opportunity when it comes to debt financing. Of course, initially, prior to 21, I think a lot of ham projects, as well as bought and annuity projects, which were being funded at the SPV level. But post that, very rarely have we seen them coming to at least the debt market to raise or refinance their loans. Most of them have actually integrated into InvITs, and then if there is no possibility of a buyback, then they continue till the period gets over, and then InvITs refinance at InvIT level, and generally that is how they reduce their cost of funding overall. And that's been a trend. Very recently, there have hardly been any individual SPVs that have raised financing, probably because of that.
Yeah, so thank you, Ankit. You have shared a important perspective of assets being transferred to InvIT, where there is a benefit of the revenue diversification, and also because of the pooling of cash flow, the risk reduces significantly. Moreover, the InvITs also derives strength from the regulations of the restrictions on the leverage, and as well as the governance related point. So thank you very much for the same. So now let's move to Mr. Chaturvedi for our next topic for the discussion, that is asset monetization. So undoubtedly, we are in interesting time with respect to investor appetite for toll roads and gaining traction in monetization of HAM projects, as mentioned by the Setu. So also in future FY 25 to 27, CareEdge Rating expects the monetization potential of HAM projects for close to 2 lakh crore, including these currently operational projects of 50,000 crore. So in this context, how do you foresee asset monetization potential in coming years as an investor?
Firstly, thanks a lot, Maulesh, for inviting me to this and a great snapshot of the entire sector. My view on this, Maulesh, is that let's look at the supply side first. And you mentioned that 2 lakh crore of HAM assets would be available by 2027. We also have NHI's monetization program happening at the same time. Now, from the supply side, we have enough projects. We have seen the traction in TOTs that is happening. At the same time, we have seen enough acquisition happening on the HAM side. So, in terms of appetite, in terms of supply, I think there is enough supply that is there available. The filters that will, of course, act on the HAM side, especially apart from various filters in terms of the bid project cost that you mentioned being lower than the benchmark, and also the quality being the main criteria for the acquisition. So if there is some restriction because of lower costs than BPC and that translating into poor quality of assets, those will of course not change hands. We have seen even now there are certain portfolios which have not been acquired for various reasons, quality being one of the reasons. So on supply side, I think there'll be these filters acting in terms of how these assets transition, and I believe that most of these assets will move to InvITs only. On the TOT side, of course, we've seen in the presentation also there is enough traction. There are enough bidders coming in and acquiring these assets, and most of the TOTs have been successful in terms of acquisition. So on the supply, I think there is enough. In terms of demand, in terms of acquisitions happening, I think over the last 3-4 years, most of the platforms have demonstrated that they are keen and more than willing to acquire. Like I explained, that they are being selective, and in terms of on the HAM side, quality being a very important criteria, and the partners that they partner with in the long term in terms of acquisition being a very important criteria. Capital has, most of the platforms, and when I say platforms, these are InvITs which are the most that are acquiring these projects. They've shown that capital is not a restriction. So in terms of the short term for the next 3 years, there are certain platforms which are currently being specific in terms of BOT toll versus TOT versus HAM specific platforms. But over a period, I think once the portfolios are large enough, I think they become agnostic and more focus on what kind of return they can provide on a blended basis across various sector types, whether it's HAM or it's BOT or TOT. So I believe on both sides there will be enough supply and demand going forward. Of course, the various parameters will play out in terms of the right asset, finding the right buyer. That will anyway play out in the near future anyway.
Well articulated, Mr. Chaturvedi. So you have rightly explained about the success on the TOT front, and there is enough supply available for the acquisition of the asset. And you have raised an important point on the construction quality and its impact on the possible asset monetization potential. So in this context, I would now request Mr. Ankit Jain to come in here for my follow-on question. So majority of the HAM projects which are slated to be operational by FY27, close to 1 lakh crore, largely they have a minimum premium over NHI cost or a 5 to 10% discount over bid project cost. And second, they have a relatively lower inflation indexation benefit as compared to the projects which are monetized. And third, they have a relatively high leverage. So in this context, do you foresee a slowdown in HAM asset monetization activity from FY26 onwards?
Thanks, Maulesh. So, as Gaurav also mentioned, see, right now there is good supply in the market, and especially see for certain portfolios or certain investors, they look at assets from say maybe a toll perspective or a ham perspective. So generally the investors who are agnostic or who are okay may go more for the TOT monetization, in my view. But I mean, generally those who want to go for ham only may still evaluate. But I think important thing to be noted here is that of late NHI also has been very clear about the quality of construction. So most of the investors are actually doing a very detailed and specific study of say the kind of construction quality which is there on these portfolios. So I think that will play a lot. So not making a generic statement, but yes, I mean some of the assets that some of the investors would have looked probably say lack in terms of quality, because one of the things that has happened is a lot of ham developers would have done a forward-looking contracts. In that kind of a scenario, the idea in the mind was always to say maybe develop a road and then sell it immediately. So probably that could have impacted the quality of construction compared to if the mentality is that someone has to construct the road and own it for a period of next 20 years. So with that, I feel that there can be some slowdown. But at the same time, I think the way investors are bullish about road sector in India, see, honestly, I mean, there is a buyer for everything at a right price. So I think slowdown may not happen, but yes, we may see a difference in terms of the multiples at which transactions are happening.
Yeah. So the big message that I can gather from you is that there is a asset monetization potential, but the valuation multiple may differ depending upon the bids and construction quality, etc. And NHI is also consciously trying to address this issue. So
Yes.
yeah, let's look at aspect. So moving to the last section of today's discussion, and that is on the developer side. So on the heightened bidding aggression and the prolonged delays in the execution. So let me begin with Mr. Rathi. We have seen in this presentation that more than 50% of the under construction NHI HAM projects are delayed beyond 6 months. So do you foresee road sector entering into the slow lane? And if yes, what all should be done for curtailing delays in execution?
Uh, yeah, so Maulesh, I agree with this that more of the projects are, where executions are delayed, right? And this is, in my earlier conversation, I told that because of various reasons, right? One of the reason is the tenure, which has been generally allocated towards any projects. It's a 2 year, irrespective of the size and the volume of the project. And then, of course, that authority is also not having, all their condition precedents fulfilling in the required time, which is again that forest clearance and land acquisition, which is getting day by day, it is getting, difficult for the authorities. So these are the major reason, and of course for last 2 years that environment is also changing, and the more rain, I would say that raining pattern has also changed. So is the raining duration has been increasing for last 2 3 years, which in Probably this is in my experience what I have seen, right? Which is also contributing towards the delay execution of the projects, which ultimately is going to, I mean, result would be ultimately that there would be delay in the execution. Road execution will certainly be on the slow lane. What has to be done is basically all the compliances are, from the authority side generally, because that financial closure is one aspect which is to be done, and then mobilization. Again, as that competition is also increasing, that developer are also facing challenge in terms of, mobilizing the resources, both in terms of manpower, money power, because that the margins are not that much high. Maybe sometimes after bidding, probably a developer can say that, okay, rather than, focusing on getting that appointed date for any particular project, I should try to avoid that appointed date may not be declared, right? So there are some instances, right? Some states are not cooperating with the NHIs, right? So there are so many reasons for which that projects are not, what we are witnessing is that projects are getting delayed in terms of execution, which ultimately would result into delay execution of the road projects. And hence government has, come up with that idea of BOT where more stake from the developer side would be involved. Whenever the project was executed before time or on time, it's mainly because of, I would say, that the concessional stakes are involved, right? If I put up more than enough money into that particular project, I'll put every efforts to get that project succeed, right? So idea is to, I mean, if that authority, fulfill on its commitment, maybe in terms of that forest clearance or land acquisition, right? If it can be delivered, that 90% of construction zone can be delivered on day one of the appointed date, and which has been so far, I mean, last 6 to 12 months, we have seen that authority is not declaring the appointed date, and there, as a result, actually, that project which was awarded in 2022, 23, so far, we have not received that appointed date for those projects, right? It was only because of those reason. So authority is also committed, right? They also don't want to be, and because of this delayed and all that, then there's a huge amount of arbitration which is going on again. So it's not going to basically benefit anyone. And authorities also basically taking appropriate steps to curtail down, on those delays. And I think BOT would be the welcome step in reducing those delays and all that. Yeah. Thank you.
Understood. So broadly, you are saying that the delays are attributed to one, land acquisition, second, excess rain, and the tenure remains 2 years, agnostic to the project complexity, and fourth, the challenges in the scaling up of the resources. And you have highlighted that the because of this 90% construction zone available on appointed date, and second, because of the NHI's plan to award projects more on a BOT toll, that would lead to the more skin in the game for developer and the more equity commitment, and can help in this curbing the delay. So, yeah, understood that aspect. So my connecting question now to Mr. Chaturvedi on this. So since those projects are getting delayed in HAM projects, and those are there also there is a perceived risk in the quality of construction. And the third is the O&M bids sometimes are aggressive for the developer. So while acquiring this asset, what are the risk mitigation strategies as a investor that you have? Yeah, Gaurav, you are on mute.
Yeah, thanks, Maulesh, for that question. Maulesh, I'll just take a step back and just see how our journey has been for the last 20 years. See, like what Ankit also mentioned, the earlier set of assets that were developed, right? They were developed for hold to maturity. So quality was never in question when they first changed hands and they were acquired. Then we had a phase initially in HAM when these were forward-looking contracts and they were bid out with the intention to be sold in 2 3 years time, right? And now we have passed that phase and we have come to a point where even the developers who have gone through a round of sale of assets understand that quality is primary. Apart from the dynamics of BPC, the quality is primary. So if quality is not up to mark, right, then whatever play BPC has, BPC play is basically in terms of what value they get finally, right? Whether it's at a discount or premium. But if the quality is not good and the cost to bring the assets to quality is very high, then the assets in the very first place don't change hands. So I think we have passed that phase, and so the assets that hopefully come through now with the developers also understanding this, that if they are not up to the quality, then probably they will not find enough suitors and enough buyers. What we've also seen as a transition over the last, say, 10, 15 years is there was a very convoluted risk matrix earlier, where investors who were coming in are mostly coming in into the developers. The risk in terms of having construction projects in the portfolio at the same time of having operating was something that they could not completely understand and balance. But now I think the rules are very clearly defined. We have one set of developers who are very clear, whether or not backed by InvIT, that they have to churn their capital after a period of time. So they are very, most of them are very clear about what their role is. Then we have the InvITs, mostly the InvITs who act as operating platforms, who acquire these assets and operate them. So I think I appreciate the point that you've made and through the presentation also, but I think somewhere the learnings of the last 6-7 years have come through, and though there have been delays, I feel the assets which meet the quality benchmarks, and like Ankit mentioned, there is a enhanced set of diligence that take place when the assets are looked for and for acquisition. So I think once they pass the muster is when they actually change hands. So I think there are learnings that have come through over the past 8-10 years that HAMs have traveled. Of course, TOT has the same set of diligence parameters that developers and platforms have to take through. So I think it has been well understood now. So in spite of delays, only the assets that can pass the muster will actually be acquired and change hands. So I think it will have to pass those filters to actually change hands. So in spite of delays, etc., I think uh, the quality parameter, I think, would not be compromised, is what I believe.
So mainly, you are saying that the litmus test of due diligence at the time of acquiring the asset, so that mitigates all those type of risks from your side. So coming back to Mr. Rathi again on this execution woes and pending appointed date of large number of projects. So with the shrinking order book of majority of the developers and large number of projects awaiting appointed date also, what is your outlook for the growth prospects and profitability of the road developers in FY25 and FY26?
See, what I believe is that in last 2 years of time, that awarding activity has gone down, right, drastically because of various reasons, and that the market has matured in terms of there are so many EPC contracted who has converted into developer. There are so many players who has come forward for taking more and more HAM projects, right? And in response, authority has also what authority has also done is basically they have also reduced the size of the projects, which is actually helping the small developer to come forward, right? So point is that overall market is coming down and more players are into this space. What I believe is that competition will remain the same for over the next, I believe that for next 2 years of time. And because of that competition, I certainly believe that I don't think that there would be a sizable growth, and particularly in the road sector, I believe that there would be certainly degrowth for all the players, because everyone would not be able to take his pie out of that market. And then because of the competition, right, margin certainly is going to come down, which I believe which should not be the case, or it should not be allowed basically given the case of that where PPP mode of where we are developing the project under PPP mode. We have to be, if the developer is keeping himself healthy by way of accruing enough margin, then only I believe that he'll be able to deliver good quality projects, and which is the need of our, right? So yes, of course, there would be degrowth, and that margin would be certainly impacted.
So your response also does echo with our study and the presentation. So thank you. Now we shall take up the questions from the audience shortly. So may I request the participant to key in the queries in your panel. Before we take the questions from the audience, so my last question is to you, Mr. Ankit Patel. So as Mr. Rathi has also mentioned that the pace of award was lower for last 2 years, and many mid-sized players, those have forayed into this space. So to mitigate this risk, what we have seen in the industry that the road developers, they have also forayed into the other segment, like tunnel construction, metro, etc., and also participated in the state projects to mitigate this
Right.
risk. So do you expect the heightened execution as well as the counterparty risk due to this strategy as a lender?
Um, yeah, sure, Maulesh. Actually, on both the points, we have some view. The one is that competition has heightened. Smaller players become larger. Larger projects become smaller. Awards, as is being discussed, have become smaller. So more people are fighting for less. Clearly, whatever has been bid out on the basis of the bid project premiums and discount itself, we can make out that competition has heightened. Now, going forward, if awards are also slowing down, there is less for everyone to pick from, then it will be a challenge when it comes to investors looking at all of this. And if the key thing that we've always noticed is that road project players or developers kind of specialize, most of them, in this segment. They know the whole thing right from the beginning to the end in terms of how to manage the execution of this project right from the beginning, and they know how to keep executing on a day-to-day basis. The moment you change and go into new sectors, it comes with its own risks. In India, infrastructure, there is water irrigation projects, there are railways projects, there are all kinds of the water development projects that are available for bidding, and some players have gone over there, and for various reasons. I mean, there would be different process of approvals, there would be different challenges of execution, the different kind of manpower, machinery would be required. It comes with a host of challenges, and it may not be ideal for all kinds of road players. And so it has also been observed that certain players have gone there and faced various challenges, because the cash conversion cycle, we feel, has always been way better in road projects as compared to some of the other segments, where there are more milestone based and sometimes even drawn out approval processes, which will mean that you will have more cash blocked, more receivables, etc. So I think it'll be player specific. Some people will be able to do that and diversify well and also gain a good traction in those other segments, whereas some will struggle and face challenges. So I think interesting times, a very difficult. I think it will be different. This is where it will. I think the stronger players and those who will be able to come through all of this better will kind of stand out. I think that kind of differentiation will play out in the next couple of years.
Okay. Yeah, it's quite insightful. So now with this, we come to end to the panel discussion. Now we will take the questions from the audience. So the first question is from Mr. Jimmy. So his question is with respect to I would like to ask this question to Ankit Jain. So while mature toll roads have outperformed, but the question is that how do you foresee the traffic diversion risk in the medium term, especially because of the construction of the Greenfield Expressway? And second, do you expect any modal shift from roads to rail and therefore the impact on the traffic?
Sure. Thanks, Maulesh. So my view is, first of all, on the model shift, I don't foresee any significant change because the way things are working and currently the plans that are there, I think road is going to stay for a lot of commercial traffic to be there, because one is, of course, India is growing, and then I mean, to meet all the requirements, I think both railway traffic and road traffic will grow. At least I personally don't feel that there will be significant model shift. Yes, on a project to project basis, we have to see. For example, with Western Dedicated Freight Corridor, you may not know what may happen to, say, some of the traffic on that specific stretch. But in general, I don't feel that there would be a model shift. And now, to your second question, which is about the divergence. Yes, I mean, it has become a very challenging thing today to assess divergence because of two reasons. One is, see, there are certain projects which are announced, so still some study can be done. Of course, now because people have seen Indian traffic, so there are some models that have been formulated and people have modified it. So I would say that still there, to a reasonable certainty, things can be forecasted for, I would say, for projects which are already announced and for which relevant data is available. But what is happening is sometimes, I mean, there's an announcement, no alignment and all. And then there's a concern whether one, that road will come into picture or not, because on some of these stretches we have only 20,000 PCUs as traffic. So you even need to take a call that while yes, there is an announcement that DPR is going on, but whether authority will finally take that call to make that a road or not, and which is one important question that people have to ascertain. And two, I would say that say after 3 to 4 years, I mean, yes, there can be new expressways. One good thing that authority has done is that they have put traffic-based target traffic or target revenue-based extensions or reductions in the concession period, which can suitably mitigate some of these risks. So authority has recently modified it also, especially in case of TOT and the new BOT. I would say that still there are some concerns in this clause because it may not adequately say cover the kind of impact that a person has, of course, because of some changes in the methodology that has been done with the authority. But yes, I mean, that's the business, I would say, because it's all given. So I think two things that I consider will mitigate is one, I mean, authority making some changes in this target revenue stroke target traffic clause, and other is, I mean, the portfolio approach that you aggregate assets. Some asset may get impacted because of say this kind of a divergence, and divergence can happen both on a positive side or on a negative side. So, I mean, in a portfolio approach, some of your assets will do good, one or two of your assets may not do that good, which can cover it up.
Okay. So the next question is from Mohit. So I would like to ask to Mr. Ankit Patel that question. So his question is do you expect any challenges in the financial closure of the projects because of the execution woes or any slowdown in the funding to the sector by the lender?
In general, on the execution side, things have only been better compared to what the situation was about 5 years back or 10 years back. In fact, all the improvements in the concession agreements as well as NHAI's own way of operation, and of course, everybody knows because of the delays and other things, there are so many claims and other things which plague this entire sector. So I think a lot of the steps that have been taken already have helped in terms of execution. Um, I think overall the sector has matured in a lot of ways. About 10-15 years back, I remember when we started out in terms of looking at road construction companies, there used to be a handful of names who used to be able to do more than 1,000 crore projects. Today, that is not the case. Today, there is a lot more penetration. There are a lot more players who are fairly sized in terms of being able to manage, the things around construction, which is a good thing overall for the infrastructure sector. So I think on the execution, I think things are way better, and some challenges will keep coming. It is such the nature of land acquisition and the nature of permissions in our country. It will continue. Some problems may keep coming, but I think it is fairly better. On the financial closure, again, as I think it's been discussed, I think there is enough supply and there is good amount of demand for good assets. There could be some differentiation which will play out because of quality of construction and quality of handover, as well as the manner in which the developer has been carrying out the things in the past and their track record in terms of completion, etc. But in general, a lot of acceptance, right, across sectors, debt investors, banking, international investors. Most of them are fairly comfortable with the way things are operating. Yes, there will be differentiation, but I don't think, at least at the moment, and now we are looking at some kind of a slight reduction in the overall awards, and while monetization may be higher, I think there is demand.
Thank you, Ankit. So next question is from Suramya Agarwal. So, Mr. Rathi, I would invite you to answer this question. This question is: ticket size of most of the BOT projects in the pipeline appear to be on a higher side. Will equity contribution be a challenge even for the sizable 7 to 8,000 crore of the top line road contractors? And his second question is how different will it be execute to metro project for traditional road player? So these two questions.
Yeah, I mean, the trends are different in terms of while NHI is giving more project under HAM with the reduction in size, but for BOT, they have come up with the bigger size of the project. Maybe some reason they would have find right in doing this. But what I believe is that equity would certainly be concerned even for HAM projects, reason being HAM market is matured and the investors are there, right, to buy out those equities, those projects, right? And if the developer is able to, churn, if the developer shows that capability to, sell the projects, flip the projects to the capable investors, right, on time, then I don't think that there would be, I mean, my colleague on this particular paper has already mentioned about this, that the equity is not the constraint. The people are there, right? Investors are there to buy operational assets with fair price. I mean, price is always subject to the due diligence and all that. But so I don't believe that equity would be a challenge. Even if that size is bigger or smaller, it doesn't matter, because EPC contractor may not be able to hold all those projects. Even if a smaller size, they will not be able to hold on their balance sheet, right? So that is one aspect. And second question was basically with respect to metro projects, if is being executed by a road construction player. So most of the activity, I believe, remains the same. I think they would be able to deliver it. Unlike that, the authority, which is common across the state, metro is I would say across the country, but metro is a state-specific subject we have to deal with. I mean, if a contractor wants to enter into metro projects sector on like that, then they have to basically deal with different authorities in each and every state wherever they want to work. Unlike NHI, where we can do national highway projects in any of the state, but the dealing authority remains the same. And I believe that the job remains the same. It's more kind of a structure work, until if it is underground metro, we have to, let's say, more and more projects would be coming. I believe that would be underground if this is happening on the inhabited area, right? And there is no space on the ground. So probably then there is a different skill set is required, and different machinery is also required. Manpower, different skill, different machinery is required. But otherwise, I believe that the road contractors would be able to execute the metro projects.
Thank you. So the next question is from Karthik, Mr. Karthik. So I invite Mr. Chaturvedi to answer the question. So his question is on the effective enforcement of the contractual terms. So like there is a clause of his question is that the like reneging of the contracts which has happened, like extension of the concession which is linked to the PC and calculation of the target traffic. So now NHI has come out with the concept of equivalent vehicle unit. But do you expect that will it help in solving this problem, or the on-ground contractual enforcement challenge will continue?
Maulesh, firstly, broadly, I would say that the authority has been helpful in terms of whenever the sector has faced challenges, whether it was premium deferment or releasing held up claims against a BG. So whenever the sector has been troubled, there has been support from the authority, NHAI. But coming to this entire target traffic bit, see, when this was drafted initially, the first set of projects that hit target traffic were around 2017-18. Till then, this clause was well understood and well contemplated. Uh, and once we actually reached the point and interpretation started, that is when the entire deliberation started in terms of PCU, in terms of rigid versus trailer, etc. And that created enough deliberation, and most of the developers are kind of stuck in terms of getting that target traffic benefit passed on to them. So I think this is a welcome move, the change that has been made, but I feel it will again go through the test of time when it's actually first tested. Uh, uh, so uh, so I feel that we will actually get to know how effective and efficient it is and enforce it when it is actually tested, when it reaches there. Because the target traffic from 2020-21, when it was to be tested in most of the projects, are still not awarded. And there are many projects that are still stuck. So I feel we will have to wait to test it before we can actually give a view on it. But it's a very positive move that we have moved into a more finer definition of the vehicle in terms of in the newer concession, so that it removes some confusion. But again, like I said, we'll have to wait till it gets tested.
Ankit, your views on this? Will you be able to shed some light on the same thing?
Maulesh, you're asking me?
Yeah, on the same point.
Yeah, because there are two Ankits we discussed.
Okay,
Yeah, so see, I would I agree with Gaurav. See, I think personally, my experience is that generally one thing that has worked for Indian road sector, especially from foreign investor side, is that it's a very well drafted concession agreement, and there are a lot of things for which you don't need to go to the government, such as things like toll increase and all. At the same time, yes, I mean this clause probably the industry has interpreted in a different way, wherein the multipliers for different PCU factor has been taken in a different way. And again, because when the clause was drafted and when it was tested, it's been a period of almost 10 to 12 years. So authority has been working a lot to mutually resolve this kind of a concern. But I think that that authority has significantly achieved one thing, especially in TOT. They have already put target revenues, and revenue is a more I would say countable number, because it's there in the books of accounts as well as in the correction. In case of TOTs, yes, I mean with the EVU concept, the way it is drafted, I think it is to cover what authority is looking for in the conflict. So definitely avoid in future. But here, which is that today and it has to be tested separately 10 years later, there can always be some ifs and buts, because I mean over last 10 years, one other thing that has happened is there has been a significant change in so why I mean, we would have seen, say, two XL trucks and a lot of LCVs. By now, we have seen a lot of, say, MAVs on the road because traffic has shifted to higher XL vehicles. So that is another thing that we have seen. So again, it has to be tested. But yes, as investors, generally investors have good confidence on authority that they will take a positive view and a reasonable view on some of these clauses.
Well articulated, Mr. Ankit Jain. Thank you. So we have many questions, but due to paucity of the time, we will take a last question. And the last question is from Mukesh Jagota, and I request Mr. Anand Rathi to answer this question. Mr. Mukesh Jagota from a financial expert. So any outlook on the pace of awarding for this year, FY25 and next year, FY26? And how much can the slowdown in the construction this financial year attributed to the halt in the award under Bharatmala? For NHAI, he's asking for NHAI.
Sorry, Maulesh, if you can repeat first. When you repeat
First question is the outlook on the pace of awarding this year and next year. That is first question.
So outlook, I would say for last almost 1.5 year to 2 years, there was no awarding or minimal awarding so far it has happened into road sector. And this was one of the reasons that Bharatmala program has been scrapped, and now the methodology basically has been changed by the government, which we heard, which is basically that the NHI has to come up with their project plan, and it has to be get approved, right, on project to project basis from the approving authority. So it is not an umbrella program, yes, but that budget was given to the authority in terms of budget was given to MORTH and NHI. I believe that maybe for last 2 years they will not be up to the mark for different reason. I mean certain portion is I would be contributing towards the election, which was prevailing all over India, right, and some state elections, some central election. But I believe in the next 3-4 months, there would be who's awarding, which was a kind of backlog, which has been, they are basically compiling. That authority has been compiling in terms of they are getting their approval and they are creating the pipeline. And over the period of next 1 to 2 years, awarding would be back on the same track. I may not see that there would be growth in terms of awarding compared to what we have seen in maybe 2 years back. But to that I mean, to same level awarding, we can see again another in next 4 months. Okay. That is about outlook. And there was another second question.
Okay. And the same question is on the construction. So how much slowdown in the construction expected?
Yeah. So basically, when we start, I mean, when awarding starts, it actually results in execution after at least 1.5 years after we can see that execution on the ground for those projects which was awarded, right? So what I believe is that in next 26 also, FY26 also, I believe that there would be kind of degrowth in terms of execution because awarding has not been happening for last 2 years, right? So maybe that growth would be again back on track after 26, maybe in year 2027.
It's quite insightful. Thank you. So I think we had a very interesting session today. And more importantly, we have gotten clear answers from the industry experts. So while boosted investor confidence for TOT and INVETS is a positive for the sector, improvement in the pace of execution as well as an award is a need of another. Enabling policy for curtailing the bidding aggression, emphasizing on a construction quality and effective enforcement of contractual clauses are prerequisite for attracting more investment to the sector. So, thank you once again, Mr. Anand Rathi, Mr. Ankit Jain, Mr. Ankit Patel, and Mr. Gaurav Chaturvedi for sharing your deep insights and patiently answering all the queries for the participants that were posed within this time constraint. I am privileged to host you all. Thank you very much, and sorry from my side for technical glitch. Thank you all participants for joining us today. I shall now hand over the session to Mamta for closing remarks.
Thank you, Maulesh, for moderating the session, and Setu for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.